We're going to look at Hormel Foods. Now we're going to calculate the intrinsic stock price using prior financial information. And first we need the market cap, which is 24.85 billion. And now the stock price, 46.20. And next we need the free cash flows. And the best way to calculate the stock price for a company is using free cash flows and estimating them into the future, and then discounting those dollar amounts back to today's values. And this is how all discounted cash flow models work. And next, we're going to pull in net income. And some people ask, how come you don't estimate net income? Although we do use net income in the model, as you can see, the reason we don't use net income is because on the income statement, it reports non-cash items and uses accrual accounting. And the next part of the model is revenue, and this is the sales of the company each year. Now we need to look at the capital structure to figure out the discount rate so we know how much to discount the cash flows by. So let's look for interest income. It's 18 million. And then we need to find out how much debt they have. So the current debt, they have no current debt, and a long-term debt of 250 million. So they pay a hefty interest rate, 7.23% interest. Now, interest is tax deductible, so we need to deduct the effective tax rate. Now let's figure that out. So the income before tax is 1.2 billion, and the income tax is 230 million. So their effective tax rate is 19%. So the actual cost of debt is 5.85%. Now we need to get the cost of equity, and we need the beta, that's the volatility of the stock. And they have a negative beta. This is the first time I've seen a negative beta on one of these videos. So their stock price moves opposite of the market. So Hormel can be considered a good hedge against market risks. Like if the market goes down, Hormel should be going up. And when the market goes up, Hormel should be going down. And this provides a really low WACC. It only cost them 1.82% to obtain financing due to that low beta. Now we're going to use that discount rate to discount the future cash flows. And we estimated the future free cash flows along with the terminal value. And when we discount those back to today's dollars, the total value of the company is $36 billion. And when you divide that by 538 million shares, you get a stock price of $66.88. So Hormel is trading at a 31% discount because their stock price is $46.20 about. And the intrinsic value is higher. Now, why would the future projections of the company not line up with the actual numbers today? Well, because people may not feel the future of the company is worth $66. They may feel it's worth closer to 46. And supply and demand of the market indicates that. Now, what do you think about Hormel? And what do you think about this cash flow model? Please also leave a comment if you would like me to do another type of video.